Are mortgage rates well above 7% in the US? Yes, currently, mortgage rates in the US are generally above 7%. Mortgage rates in the US have indeed surpassed the 7% mark in recent times. This shift has significant implications, particularly for those aspiring to buy a home. The prevailing rates make homeownership more challenging as the increased rates directly translate to higher monthly mortgage payments. To put this into perspective, let's consider an example. If one were to purchase a home at the median price in the United States, approximately $430,000, and make a standard 20% down payment, the borrowed amount would be $344,000. At mortgage rates exceeding 7%, the monthly payments become noticeably steeper, impacting the affordability of homes. This rise in mortgage rates is part of a broader economic landscape where interest rates play a pivotal role. The Federal Reserve's approach to monetary policy is a key driver in this scenario. As the Fed aims to address inflationary pressures, one of its primary tools is the adjustment of short-term interest rates. The recent increase in these rates has consequently led to a corresponding uptick in mortgage rates. The practical implication of mortgage rates surpassing 7% is a market where the cost of borrowing is higher, influencing the decisions of potential homebuyers. Affordability takes center stage as individuals and families evaluate their financial capacity to navigate the real estate landscape in the face of these elevated rates. How high will mortgage rates go in the U.S.? Mortgage rates in the U.S. are poised to remain notably elevated, hovering around 20-year highs. Projections indicate that these rates will likely fall within the range of 7% to 8% for a standard 30-year fixed-rate purchase loan. These estimates are based on assessments by reputable sources in the housing and financial sectors. Fannie Mae, a leading source for housing market insights, has put forth a forecast indicating an average mortgage rate of 7.3% for the year 2024. This suggests a sustained period of relatively high mortgage rates, impacting the affordability of homes for prospective buyers. The Mortgage Bankers Association, MBA, has a somewhat more optimistic yet cautious outlook. Their projections suggest that by the end of 2024, mortgage rates could potentially dip to around 6.1%. While this is a lower figure compared to the current rates, it still signifies a market where borrowing costs remain considerably high compared to recent years. These projections highlight the expectation that the current trend of elevated mortgage rates is likely to persist, shaping the real estate landscape in the coming years. Potential homebuyers will need to factor these higher rates into their financial planning, recognizing the impact on monthly payments and the overall affordability of homeownership. Why are U.S. mortgage rates so high? The surge in U.S. mortgage rates is attributable to a combination of factors, with a prominent role played by the Federal Reserve's strategic decisions. The primary driver behind the recent escalation in mortgage rates is the Fed's policy of raising short-term interest rates. Historically, the Federal Reserve has utilized interest rate adjustments as a primary tool to combat inflation. In the face of rising inflationary pressures, the Fed has opted to increase short-term interest rates to cool down economic activity. This strategic move has a cascading effect on various interest rates across the economy, including mortgage rates. The decision to raise short-term interest rates has a direct impact on the cost of borrowing, influencing the rates at which individuals and businesses can access credit. In the context of mortgages, higher short-term interest rates translate to elevated long-term mortgage rates, making borrowing more expensive for homebuyers. Additionally, broader economic factors contribute to the overall trajectory of mortgage rates. Market forces, global economic conditions, and investor sentiment also play roles in determining the prevailing interest rates. The interplay of these factors creates a dynamic environment where mortgage rates can experience fluctuations.